Hello, everyone. It is 3:30 p.m. Central on the second Wednesday of October. And what that means is that we are here for the first webinar for OIC in October, the first of two. My name is Mat Cashman. I'm the Principal of Investor Education at OCC. I'm also an instructor at the Options Industry Council. And today we're going to talk about volatility, option pricing, Vega, and implied volatility. Thank you, everyone, for joining us today. For the next hour or so, we're going to be talking about volatility and option pricing. We're going to lay the groundwork with a baseline view of implied volatility, pricing, and a little foray into the Skew topic at the end of today's presentation. And then next week, make sure you also check in on the 18th, because what we're going to do is we're going to take today's lesson and we're going to really turbocharge it into how implied volatility and skew are interrelated. And we're going to do a real deep dive into option skew. So if you've ever wondered about option skew, next week is going to be the one for you. But I hope you stick with us today as well. My name is Mat Cashman. Again, I'm the Principal of Investor Education at OCC, as well as an Options Industry Council instructor. Today, we're going to talk about option pricing, Vega, and implied volatility. I'm going to cover the basics more broadly. We'll dive into how you might see option prices move because of these concepts. Hopefully, we'll give you some context within which you can use these ideas to make better informed trading decisions in how you think about and eventually trade these options. Just to give you a little bit of background on myself, I started trading in 1998. I've been an options trader ever since. I got my start in Chicago trading equity and index options on the floor of the CBOE. Pretty quickly after that, I moved to London, where I traded interest rate options there for about 3 years. I eventually moved back stateside, where I started and ran an index options market making operation for the better part of about a decade in Chicago, again on the floor of the CBOE. Currently, I work at OCC, helping individuals and investors to better understand both risks and the benefits of exchange-traded options through efforts like the webinar that you are watching today. Now, we always include a disclaimer to make our lawyers happy. Options involve risk. They're not suitable for everyone. In order to simplify calculations in these materials, interest and taxes have not been included. Any strategies that I discuss, including examples of actual securities, are strictly for illustrative and educational purposes. Please do not construe them as an endorsement, recommendation, or solicitation to buy or sell securities. Past performance, not a guarantee of future results. Now, one other bit of housekeeping. The following trademarks, logos, and service marks displayed are owned by the Options Clearing Corporation. You will see them used throughout the presentation today. Let me give you a little background on OIC. The Options Industry Council is the educational arm of our parent company, the Options Clearing Corporation. You'll see both of these, OCC and OIC, throughout this presentation today. OCC is the largest clearing corporation of equity and exchange traded options in the world. Now, OIC, the Options Industry Council, started out as a collective in 1992 with the aim to better educate the public as to the risks and the benefits of exchange-traded options. Currently, we continue to pursue that goal mainly through the utilization of our website, which you'll see right here, optionseducation.org. There you will find online courses, podcasts, videos, webinars like the one you're listening to now. It's important that you understand we are able to provide these services free of charge to the public because we are fully funded by our parent company, the OCC. Now, I work at a division of the OIC referred to as the Investor Services Desk or the Investor Education Desk, where I sit with 3 other amazing colleagues. You can send us email questions at this email address, options@theocc.com. This, again, is a free service that we extend to the public as well. It's important to note we are not registered investment advisors, so we can't direct you on trades or suggest investment strategies. But what we can do and what we love to do is we love to help with general questions about options, optionality, and theoretical knowledge surrounding the options ecosystem. Amongst the four of us that sit on that investor education desk at OIC, we have over 100 years of combined industry experience surrounding options. We're always happy to help in whatever way we can to further advance your understanding of options and how to responsibly use them every day in your investing. So make sure you send us email questions at options@theocc.com. You'll get a real live answer from a real live person with some real life options trading experience. I'm very fortunate to have all three of my colleagues that sit on that desk with me today, handling the Q&A portion of the webinar throughout. Please say hello to Roma, Mark, and Ken behind the scenes. They will be answering your questions live on the chat during my presentation. And provided we have enough time, hopefully they'll be facilitating the Q&A at the end of the presentation as well. So with that, let's dive right in. I always start my presentations with this slide. And the reason why is because this is annual options volume from 2000 to 2022. What you don't see on this is 2023, which right now looks like it's right around this point in time, but it also is forecasted to be at the end of the year around this point up here, well past 10 billion contracts again. I think it's important to put this up because I think it really drives the point home as to what has been happening in the options world for the last 20 or so years. And what you see here is an absolute explosion of options usage and volume. What that means from my perspective as an educator, that's basically what I do on a daily basis, is I want to make sure that all of these people that are in here trading options understand how these leveraged contracts work. What can you do with options? But also, importantly, what can't you do with options? What will they not do? How can I use them? How can I not use them? Where are my risks? Where are my benefits? What can I do with these contracts? Because they're exceptionally flexible and they have so many use cases, but you have to understand how they work. And so it's important from our perspective that the users of options are well informed and have a solid knowledge base from which to make these informed trading decisions. And that's why we do what we do every day on a daily basis here on the Investor Education Desk at OIC. Let's get right into what we're going to talk about more specifically today. In this presentation, we're going to talk about historical volatility. We're going to talk about historical vol and its cousin, implied volatility. Spoiler alert, one of these is backward looking and one of them is forward looking. I think you'll probably be able to guess which one is backward looking based on what they're called. Historical vol is your backward looking metric. Implied vol is your forward looking metric, but we're going to dig into both of them and I'll tell you why they matter. Also, we're going to talk about Vega as a concept. We'll talk about how it affects pricing in options and what it means as a metric, how you might be able to look at it and gauge what a Vega metric means for an option price and what you might expect that option price to do based on how your model is telling you how much Vega is in an option. And then finally, we're going to touch on the actual Skew portion of this as a teaser for next week's deep dive into Skew, which will be called Understanding Option Skew. That's going to be a deep, deep dive into Skew and why it matters as far as option prices are concerned. Both of these presentations are going to be centered around, you guessed it, the concept of implied volatility. Because implied volatility is one of the biggest factors inherent within the price of an option. We'll get more into that in a moment, but first, let's talk about historical volatility. As you might imagine, historical volatility is merely a measure of the fluctuation in underlying price. Now, underlying price doesn't necessarily mean that when you're measuring historical volatility that you're denoting a difference between a move to the downside or a move to the upside. When you're measuring historical volatility, you're really just measuring how much something is moving. You're not talking about whether it moves to the upside or the downside. Now, historical volatility is measured over a specific time period. Sometimes it's days, sometimes it's weeks, sometimes months, or longer. This is all based on how you want to look at and quantify how much something is moving. But the basic concept here is that historical volatility is a measurement of how much something is moving over n number of days or weeks or months. It does not imply a price trend. Like I said, when you're measuring historical volatility, a 5 standard deviation move to the downside is the same, relatively speaking, as a 5 standard deviation move to the upside. It doesn't matter which direction it's moving because you're just measuring gross movement over time. That's really all you're doing when you're talking about historical volatility. Now, here's a kind of a crude graph to drive the point home. This is really a way to kind of make the point, right? There's a stock that's in black, a stock that's in orange. Let's pretend for a moment that you own the black stock and someone else owns the orange stock, maybe your best friend. And on this date, both of these stocks are trading the same price. Somehow, through some chance, both of you get marooned on a desert island, and we fast forward past n number of days, and the same prices exist for both the orange stock and the black stock. You could look at those two prices, where we started and where we ended up, and look at it and say, not much happened. However, that doesn't tell you the whole story, does it? And actually, if you look at it, it doesn't tell you the whole two different stories that are actually going on here. While both of these stocks started at the same place and ended at the same place, theoretically, they took different routes to get there. And one of these stocks, this black stock, is going to have a much higher historical volatility number over this period of time because it's just moving more. Notice that I didn't say it's moving up more or moving down more. It's just moving more. It's moving up and down more. And so this black stock is going to have a higher historical volatility number over this period of time than the orange stock is because it just moved more. Keep in mind, looking at one point in time or another point in time does not give you the correct frame of reference for historical volatility. Looking at the entirety of the price history over that period of time is what gives you that context to be able to understand what the historical volatility number actually means. So, when we're talking about historical volatility, we're really just measuring how much something is moving over time. In that regard, historical volatility is backward looking. It's a measurement of movement over a period of time that has already happened. It is a stock's previously delivered amount of volatility. It can be observed, quantified. It's backward looking. It's historical vol. It's a statistic. It's a fact. It's not a prediction, and it's not a forecast. The other kind of vol that we're going to talk about today is implied volatility. And implied volatility comes into play when we're starting to talk about predictions and forecasts and prices of options. We'll get to that in a moment. But first, what I want to talk about, aside from the historical volatility and how you measure it, is what it looks like when you're talking about it from a probabilistic standpoint, when you look at price distributions relative to historical volatility. When you're comparing distributions of stocks or underlyings that all have different delivered volatility profiles or different historical volatilities, what you're going to see is that not only do they have different historical volatility levels based on how much they move independently, but their actual price distributions start to look differently based on what their historical volatility levels are. And what I mean by that is if you look at this set of price distributions, all of them correspond to these different stocks that have different historical volatility numbers. Let's take, for instance, this gray stock, which obviously has the lowest historical volatility number of these three securities. If this stock is moving at a 15 historical vol, that means out of all of these three, it's moving the least. What you can also infer from that is that when you have a situation where something is moving not very much, where it's got a low historical vol, as far as the price distribution is concerned, what you're going to get is a price distribution that is pretty narrow and has a relatively high amplitude as far as this is concerned. Why is that? Well, if you consider this as the $100 mean, and you consider this $100 mean for all three of these stocks, a stock that has a low historical volatility that's not moving very much is going to be trading around the mean on a daily basis. One day it might settle 99.5, and then the next day it might settle 100.25, and then it might settle 99.75, and then 100.1. It's going to be clustered. All of those price iterations are going to be clustered around this mean. And when you cluster those price iterations around the mean, what you end up with is a very concentrated, high amplitude distribution with a narrow breadth to it. Now, as you get more and more historical volatility in there, as something starts to move around more, what you're going to end up with are price iterations and settlement iterations that are farther away from the mean. Now, they may not be very likely, but they are going to be farther away from the mean. The reason why is because a historical vol that is higher implies the idea that the thing is moving around more. And if it's moving around more, its price settlement iteration is going to vary more away from the mean. Well, as you do that, what ends up happening is these price distributions get flatter and flatter and flatter and broader and broader and broader. What this means is that as historical vol numbers tend toward infinity, the high bound of infinity or the not bound of infinity, as the case may be, the actual pricing distribution starts to look flat, like a straight line. And why is that? Well, let me tell you a kind of like real world story to drive this point home. In 2008, it was the most volatile time I had ever seen in the marketplace. I was making markets in the SPX on the floor of the CBOE on a daily basis. If you were to come up to me before the open and say to me outside of the trading pit, hey, the S&P 500 is going to settle 7 standard deviations away from where we are right now, today, I would look at you and say, well, I don't know, maybe. I mean, it's possible. 2 days ago, we settled 5 standard deviations away. And 3 days before that, we settled 4 standard deviations the opposite direction. So why not? And what that means is that when you're in an environment where historical volatilities are exceptionally high, when something is moving around an awful lot, all of these price permutations, all of these potential price settlements start to become equally as likely. And if you get something that has an equal likelihood of price settlement all across the entire spectrum of prices, guess what? Your distribution starts to look like a straight line, straight across here, because there's no clustering of settlements around the mean. They should be theoretically evenly distributed across the entire price spectrum. The reason why I make this point is because distribution of price is very tied to how skew and implied volatility look and are modeled. It's important that you understand the actual relationship between implied volatility and price distribution, as well as historical volatility and what that price distribution looks like, because it informs the idea of skew and implied volatility and how things are priced along the curve. It's an important thing to keep in mind as you start to conceive of options and implied volatility. Now, let's dive right in to implied volatility itself. Implied volatility is a function of option prices, meaning only options have implied volatility. It is the main input for all option pricing models. From a market maker's standpoint, implied volatility is the biggest knob or dial that we have at our disposal, that I used to have at my disposal, that market makers have at their disposal to change prices in a broad-based way very quickly. The best way for you to change the actual price of an option as a market maker, as someone who is modeling these options and broadcasting prices to the marketplace, is to change your implied volatility, because what's it going to do? It's going to change all of the prices within that month. So if I take the May options as a market maker and I dial that implied volatility from 17 up to 25, the option prices all in May are going to change significantly. And I'll get to why that is and how that works, but it's the main input for all option pricing models, and you need to remember that. It reflects the current forecasted volatility assumptions with respect to current underlying price and movement. And it's an idea, it's a forward-looking metric, it's a forward-looking forecast for how much something is theoretically going to move over the lifetime of that option. It reflects the marketplace's best guess, essentially. It's the marketplace's current forecast for how much this underlying stock is going to move for the next N number of days. And so if you have an option that has 30 days in it, if it's a 30-day option and it's trading on a 20 vol, a 20 implied vol, what that means is that the marketplace right now is pricing those options with an idea that the next 30 days is going to be best reflected in price volatility, historical volatility. After that 30 days is over with, we're going to look back on the last 30 days and hopefully it's going to be a 20 delivered historical vol. That's what the marketplace is saying when it's pricing options on a 20 vol. It's saying that over the next N number of days, we expect this underlying to move that much. Now, again, it's the consensus of all the market participants that are in there. It is a dynamic number, meaning it moves around constantly during the day. One of the things that I like to teach when I teach about implied volatility is the reason why it's called implied is because it's attached to the price of the option. It is implied from the price. And so as the price moves, the implied volatility also moves. Now, it's not going to move one-to-one, and it's not going to have an exact relationship, but the reason why it's called implied volatility is because that metric is implied by the price of the option. Now, implied volatility represents the market's best guess of how much something's going to move. Previously, I showed you a graph that had just historical volatility on it, and it had stock price over here, and it just had N number of days up to this point, and it was backward looking. It was historical volatility. What this tells you is, how do I put these two things together? Historical volatility is looking backward from today, and implied volatility is looking forward from today. It is a forward-looking metric, and it is the market's best guess as to how much something will move over the next N number of days. It is the current expectation of future stock volatility, forward-looking, and it's implied volatility because it is implied from the option prices that are out there in the market right now. Now, let's talk about how you can take these two concepts and stick them end to end. Implied volatility can be at really great variance to a stock's historical volatility. What that means is that they're not necessarily connected to each other. We get a lot of questions about whether or not implied volatility and historical volatility are linked. And the answer to that question is, well, yes and no. In real terms, they're not linked. They're independent, and one of them looks backward and one of them looks forward. And if you ask me that question, I'm going to tell you that every single time. In other terms, they are, let's call them tangentially linked. And they're linked by that one point in time, which is today. Everything up to today is historical vol, and everything forward from today is implied volatility. It's the prediction of future stock vol, so it's not really right or wrong. It's just a prediction of how much something is going to move. You should expect implied volatility to change on a minute-by-minute and day-to-day basis. This can occur intraday. It can occur over a long period of time. But remember, implied volatility is called that because it's implied from the price of an option. If you're expecting the prices of options to move, you are thus expecting implied volatilities to move. Those moves may happen quickly and significantly. Here's a really important point. It doesn't require a change in the stock price, in the underlying price. Many times, and I'll give you an example of this later on in the presentation, but many times what people get so flummoxed by is a situation in which the stock doesn't move, but the implied volatility does. Because people are so conditioned to think about the fact that implied volatility is a function of underlying movement. And the reality of the situation is they are not necessarily linked. Many times, and we'll talk about this when we talk about skew, many times price history of the underlying actually informs how the actual implied volatility curve looks. But that doesn't necessarily mean that they're linked. And a lot of time when, as a professional trader, a lot of the differences in P&L that come from circumstances that play out and actually have P&L that are different than what we expected, the reason why is because the implied vol didn't move the way that we expected it to move. It moved maybe the opposite direction, or maybe it didn't move at all, and we expected it to move. So it's important that you understand that moves in implied vol are not necessarily tied to moves in underlying stock. Thus, it is generally a very dynamic feature of any options premium. It moves around along with price. Now, we get a lot of questions about implied versus historical volatility. Here are a couple of them. Will an options implied vol return to its underlying stock's historical or delivered volatility level? This question comes in all the time when, for instance, a stock has a long-term historical volatility of 20, and right now the options happen to be trading on a 50 implied vol. And people always want to know, is it going to return? Is it going to go back to 20? The answer is not necessarily, and please do not assume that it will. There's a really interesting saying about the market, which is the market can stay, what is the saying? It's something about the market staying, well, whatever. The market can stay, I forget, longer than you can stay liquid or something like that. Don't assume, the bottom line is, don't assume that the actual implied volatility is going to mirror the historical volatility, because it's not always going to go back to where it was, theoretically. The other question we get all the time is, why do I care? Why do I care about implied volatility levels? And my answer to that is always, if you care about option prices, you care about implied volatility levels because they're linked, right? Implied volatility is named that because it comes from the price of the option. So if you care about whether or not the option price is moving, you care about whether or not the implied volatility level is moving. It directly affects the market value of your options based on, the price of the option. time to expiration, extrinsic value, etc. And it's not always predictable. So many times people, like I said, are flummoxed by situations where they don't understand what's going on. And a lot of time when people ask those questions, the answer is inevitably, have you looked at the implied volatility levels of your options? And that speaks directly to this question, which is, why do I care about implied volatility levels? The answer is, especially in situations where you have a P&L that maybe you can't necessarily explain. I don't understand why these options lost money, or I don't understand why I lost money on the options when I made money on the stock, et cetera, et cetera, et cetera. Always, always, always. Not only look at the price of the option, always look at the actual implied volatility levels of the options, because those are moving around as long as the prices are moving. Now, implied volatility moves option prices, but there's a lot of different things that can move option prices. When I talk about implied volatility and I give you really hard and fast statements about like implied volatility moves option prices in this way, the reason I'm doing that and the way that we can come to that actual conclusion is because we're thinking about it in the context of everything else staying constant. If you think about everything else staying constant, meaning the price of the underlying, the strike price, the days to expiration, the kurtosis that's around the option, the skew, all of those things staying constant, and implied volatility moving, as implied volatility increases, both call and puts will increase. Their prices will increase. And thus, if you're keeping everything else constant as implied volatility decreases, the actual levels of puts and calls, their prices will decrease. I can say this definitively because of this statement. If you keep everything else constant and you move implied volatilities around, as implied vol goes up, call and put prices are going up. And as implied vol goes down, call and put prices are coming down. Now, this begs the question, how much do they move up and down when we move implied vol? And the answer to that is Vega. Where do we look for how much these options should be or could be moving when we move implied volatility? Many of you who follow a lot of our OIC courses are going to be very familiar with the concept of Vega because it is it is one of the first order Greeks. Delta, gamma, theta, vega, and rho. Actually, gamma is a second order Greek, but we kind of group it in with all the first order Greeks because a lot of people put it on their headline risk for their entire position. Vega is a first order Greek. It's one of those things that can tell you how your position might move if implied volatility is moving around, and this is how. Vega is the volatility Greek. It is a measure of an option value's sensitivity to movements in implied volatility levels. It's represented by the letter K, and it represents the expected change in your option value when you move implied vol 1%. It's expressed in decimal form. Much like many of the Greeks, you're going to see this expressed as a decimal. And it'll be generally expressed as a number that's next to the option, usually on the line that the option is on, the strike that it's on. If you're looking at all the Greeks, Vega is going to be on there, and it's going to be on there as a decimal. In this case, we would look at this, and if I were talking to someone on the investor education desk who knows a lot about options, and we were just conversing about options, we'd say this option has 8 cents of Vega. How much Vega is in it? Oh, it has 8 cents of Vega. And what that means is that if you move the actual option by 1 percentage point in implied vol, the cash amount of that option should move, theoretically, based on your model, by this number. With every 1% change in implied volatility, an option should theoretically move by its Vega. In this case, 8 cents. So if we had an option that was worth $1 and it was trading on a 20 implied vol, and then we came in the next day or later that day or 2 seconds later, and the implied vol was trading 21, up 1%, what would we expect that option to be worth? Well, it started worth $1 and it has 8 cents of Vega. And the implied vol went up. Thus, the option should be worth about 108, 1.08. Now, again, all other pricing factors need to remain constant for us to be able to really extrapolate out the fact that the movement in that price of the option is 100% based on Vega or based on the implied vol move. But if you can do that, you can forensically look back at options and figure out why they're moving the way that they're moving, if you have a good handle on where the implied vol has been and where it is now. Now, Vega is concentrated most in at-the-money options and long-term options. I'm going to say that again because this is really important. Vega is most concentrated in at-the-money options and long-term options. The more time an option has in it, meaning the more potential price settlement iterations, the more days to expiration an option has in it, if it has the same strike as a shorter term option, that longer term option is going to have more Vega. What does that mean? It's going to be more sensitive to implied volatility moves. It's going to move more in cash value for every 1% move in implied volatility. Again, Vega most concentrated in at the money and long-term options. So if you're looking for an option that has a lot of Vega in it, your best bet is going to be to look for a really long-term option that's at the money, because that's where the most Vega is going to be. Now, here's an interesting thing. Calls and puts both have positive Vega amounts. I get a lot of pushback when I teach gamma this way because I teach gamma the same way. Both of these have positive Vega amounts, calls and puts. Both calls and puts also have positive gamma amounts. And so the question invariably becomes, well, I always hear these pundits talking on CNBC or Squawk Box or whatever about dealers having negative gamma positions or negative Vega positions. How is that possible if all options have positive Vega amounts? And the answer to that question is the options themselves have positive Vega or positive gamma. It is what you do with that option that actually creates a positive or a negative Vega position that's associated with your option position. So if all you do is buy options, and you buy this option, and then you buy this option, you buy this option, buy this option, buy this option, and then you buy this option, and you have 10 options in your account, and all of them are long, guess what? You're going to have a long Vega position. Conversely, if all you do is sell options, sell, all you're going to have in your position is short options, and thus you're going to have a short Vega position. And what that means is that you are going to have long exposure or short exposure to the way that options move based on their implied volatility levels. As implied volatility option values are going up, they're going up by their Vega amounts if you keep everything else constant. And the opposite is true as well. If you're moving implied volatility values down, you're moving option values down by their Vega amounts. The reason why is because these options have positive Vega. The Vega measurement is the actual measurement of the net possible change of the option when you move the implied vol up and down. So I want you to think about what that means if you actually were to conceive of Vega as a negative number. That would mean as you were moving implied vol up, option values would go down, which doesn't necessarily jive with how they actually work. Plus, it's a measure of potential change in the option. And so measuring the potential change in a negative way goes against everything that belies these contracts as far as the math is concerned. So let's talk about this in in a slightly more real world terms. We're trading a $50 stock XYZ, this hypothetical stock. You go and you look at the $50 call and you think it's worth $3. You might buy it for $3. Stock's trading 50. This is your at the money option. You've got 60 days to expiration. The next day, stock moves around, maybe trades 48 to the downside, maybe trades 52 to the upside, but settles again at 50. Then you look at the settlement price of the call, and it's trading $3.40. What happened? Well, what I said before holds true here. If you have a situation where you're a little bit unsettled with what happened to the price of the option, the first place you should always look is the implied volatility level. Because there's going to be very few things that are going to change in a dynamic way like the implied vol level is, because it's tied to price. And so if the price is moving, which is causing you to be looking into why your P&L is whatever it is, guess what? If the price of the option is moving, it's most likely that the implied volatility is moving as well. Not always, but most of the time. And so in this case, the level of the D50 call implied vol has moved from a 35 up to a 40 the next day. If you're long it, you're going to be super happy because you may not have a really great explanation for what happened, but you were long something that started the day at 3 and ended the day at 340. However, if you're short this option, if you were the writer of the call, you might not be so happy. And you might be digging a little harder as to why this happened, trying to figure out why this happened. Why is this call that I sold at $3 trading 340? Well, either way, if you're long it or you're short it and you're looking for a reason to explain price movement, a great place to start is the implied volatility levels. Let's take another look around something that happens a lot of time around events in single stocks, right? Events in single stocks like earnings. In this case, we have a $100 stock. We have 13 days to expiration. The implied vol is 50. We're looking at the 105 call. Its value is 185. All right, keep those in your mind. 185. Delta is 30, gamma is 5, theta is 15 cents, and this is the number we're thinking about here. It's got 10 cents of Vega. Now, let's fast forward. Post earnings, and we're going to go 7 days out. Stock has moved up $5. Look at how the delta has changed. It's gone up. As you get closer to at the money, this delta is going to go higher. Gamma also, as a function of an at the money, as closest to at the money, gamma is going to be higher. Theta has gone up as well because we're taking more time out and more of that extrinsic value is going to need to come out over only, guess what, 6 days left. Vega has gone down. Remember, Vega is a function of time. If an option has more time in it, it has more Vega in it, as long as the strike is the same. Conversely, if you take time out, Vega is going to come out, so it has less Vega in it. The price of this option is what is most concerning to a lot of people. Why did it go down? The stock went up. It's the same strike call, and calls are theoretically supposed to have a positive correlation to underlying. Even with a $5 increase in share price, these calls lost value. Why? Due to time decay and decreasing implied volatility levels. Like I said, if you have a question about why an option is moving the way that it's moving, oftentimes your answer is going to be embedded somewhere in this number. It's a great place to start to look because it'll give you a picture of what's actually going on as far as the implied volatility levels that are inherent in the option price. Now, if you are to take an entirety of 1 month's options on all of these different strikes, right? Many of you have looked at an option montage in, June options for stock XYZ, and there's 75 different strikes. Well, guess what? Each one of those strikes has its own implied volatility level. Why? Because each one of those options has a different risk profile that is associated with its payout structure, relative to how far away its strike is from the at the money strike, thus affecting the probability of that option to finish in or out of the money. That probability is reflected by another Greek called delta, but what it also means is that each strike, because each strike has its own profile, has its own implied volatility level. If you take all of the implied volatility levels for 1 month that exist on all of these strikes and you graph them, what you end up with is a concept called skew. And I'm going to give you a quick history of skew and where it comes from. Option skew has existed for as long as modern options have been around, which dates back to the early 17th century, when the first kind of modern options were traded in Amsterdam on tulips. Price data from trades that are actually in the record books for that time indicate that people actually paid more for exposure to the upside than exposure to the downside. Tulips cost so much money at that point in time because there was so much fervor around the price of them going up that people started to price options on them because they didn't have enough money to buy the underlying tulips. They had to price the right to buy the underlying tulip. And that's where the options, the modern options, came from. Now, fast forward a little bit from that 17th century to the 80s and the 90s and the 2000s, when we have these giant financial crises in the United States and some of them globally. And this is where the birth of modern skew really comes from. Modern skew is really baked into how people think about options now and how they are priced on a daily basis. Now, in the 80s and the 90s and the 2000s, right? 87 and 93 and 2008, people started buying puts as hedges against potential market downturns. They bought out of the money puts. When you have a situation where one side of the price distribution, the put side in this case, is more desirable than the other side, and the actual supply of options on that side doesn't match the elevated demand, prices are going to go up. Skew is a function of supply and demand, just like prices of options are. And so that's why you see now skew be built into how people price options. And in the equities and indexes, generally speaking, you have what's called negative or put skew, meaning the puts, the out of the money puts, are priced higher than the out of the money calls. Why? Because of this price history. Because when things in indexes and equities crash, they generally crash to the downside, not to the upside. And so the fear and the fervor is in those downside puts. That's why they trade at an elevated level relative to the calls most of the time. Now, since then, option skew has really been baked in. It's a standard feature of how people think about options. And I'll tell you this, when you're trading options and you're a professional options trader, you don't even really think about skew as a concept anymore because it's just part of how you conceive of price. It's kind of built into how you think about the option. And that's how pervasive this concept has become within the actual math that underlies these concepts and options. Lots of times now you'll see traders and investors that use the concept of skew to actually design full trading strategies built around that concept, around how these options trade relative to other options. So let's give you a real hard definition of what skew is. This is the technical definition, and it's got a lot of words in it. Skew is the difference between the volatility level of the at-the-money option and the volatility levels of the out-of-the-money calls and puts. What does that mean? It means if you take all of the options in 1 month and you graph them, skew is the difference between where the at-the-monies, the out-of-the-monies, and the in-the-monies are trading. What level of implied vol do I have to pay if I'm buying a 10% downside put versus a 10% upside call versus the at-the-money option. That is skew. It can be measured, quantified, and talked about in lots of different ways. Like I said before, skew is ultimately a function of supply and demand. That means, just like implied volatility, skew itself, which is a measure of implied volatility, can be quite dynamic, unpredictable, and it can move a lot. That also means that equities and indexes in the United States, in the equity and index market, tend to have out-of-the-money puts that are higher than out-of-the-money calls. And this is generally dictated by price history. Like I said, equities and indexes crash to the downside, and they stair-step in price to the upside. So what you end up with is a skew that might look like this. This is a graphic representation of what put skew might look like, or negative skew. These are your strikes on the x-axis, and these are vol levels, implied volatility levels on your y-axis. And if you look over here, this is probably something that's trading around 50 or 55 bucks. It's a stock that's trading 50 or 55 bucks. This represents those out-of-the-money calls, those upside calls, and this represents those out-of-the-money puts. And if you take the price and the price that implies that implied volatility level and you graph it per strike, this is oftentimes a very generalized idea of what a product with put skew is going to look like for 1 month's volatility skew. So what we did here today is we talked about, remember, historical volatility. It's a measure of how much something has moved previously. Then we built on that by saying implied volatility is the next level. It's the options best guess, the market makers, everyone who's involved in pricing options. It's the market's best guess as to how much something's going to move going forward. Then we talked about Vega, which is how much you can expect an option to move when you move those implied volatility levels. And then lastly, we built out this idea of skew, taking implied volatility levels from all these different strikes and graphing it, and then looking at what those different price levels mean in implied volatility terms, one option versus another option. So I know I gave you a lot of information today. I hope that you'll come back next week, because next week we're going to finish this idea on skew, and we're going to move 10 rows deeper into the idea of how skew works, and hopefully give you a better understanding of how skew works from the top all the way down to the bottom of how skew works. Make sure to send us email questions at options@theocc.com, and check out all of our educational materials at optionseducation.org. It is a great resource where there's a wide selection of information around options. It's a resource that when people end up engaging with it, we invariably get comments like, I cannot believe that you give this away for free. And the answer is, the reason why we're able to do this is because we're fully funded by our parent corporation, the Options Clearing Corporation, OCC. But OIC is here to teach you about options. That's what we do on a daily basis, and we are here to help you understand how options work more broadly. So, do we have time for some questions? Mark, are you there? Or Ken or Roma?
Hey, Matt, can you hear me?
I can. Ken, how are you, sir?
Hey, I'm good, sir. How are you? Thank you for that.
I'm doing very well.
That was a lot of really great information. So yeah, we did get some interesting questions. So let's just start with the first one here. So somebody was asking about, what are your thoughts on the difference between the ratios between IV and HV as a guide to picking or structuring an options trade? And I know there's many different ways to analyze implied volatility. You can look at implied volatility charts. You can look at IV percentiles, and whatnot. But but some people do, analyze those ratios. I know you were kind of talking about this in some of your other presentations outside of OIC. So maybe you could talk a little bit about, using those ratios to decide whether implied volatility is relatively high or low versus the historic vol.
Yeah, that's a really good question, and it speaks to the idea that we touched on at the very beginning of this, which is that historical and implied volatilities. Remember, I said that they were kind of tangentially linked to each other, and the reason why I use that word is because one looks backwards and one looks forwards, right? And that's the basis of really the difference between these two metrics. But it doesn't mean that you can't utilize them carefully in how you kind of build a view of what's happening around you as far as the market's concerned. And in many ways, that's how I used to use them. And that's how a lot of investors actually use them currently, is that if you're going to compare the level of an implied volatility right now that's looking forward and the historical volatility over N number of days, it's important that you conceive of that ratio of those two numbers in a way that gives you kind of an apples to apples comparison. So for instance, I think that apples to apples means, like, if you're looking at a historical vol that represents 30 days of price history, and you're looking at an option that is a 200-day option, those two things don't necessarily have a whole lot to do with each other. And we're actually already kind of tenuously putting those two things together as is, right? The historical and the implied volatility levels, like I said, are tangentially linked already. And so it's probably best, if you're going to compare those two numbers, to try to get them as close to apples and apples and oranges as you can, which oftentimes falls into the category of looking at 30 days worth of price history and maybe a 30-day option against it. That might be one way that you can actually try to narrow that gap between those two things to make them seem more comparable from a mathematical perspective.
Right. That makes a lot of sense. And, to your point earlier where you were talking about historical vol and it being backward looking, just because a stock has been not volatile in the past does not necessarily mean it couldn't move in the future, and vice versa. So, if you see a stock that's, historically it's trading at a 25 vol, but the options are trading a 50 vol, they're obviously priced. The market's anticipating greater movement. Now that may or may not happen. And just trading based on a ratio, you might say, oh, these options are expensive, I'm just going to sell them. Well, that may or may not work out. Sometimes they're priced for a very good reason. So always keep that in mind when you're making trading decisions. Like, the overall levels that you're buying or selling can go a long way into helping you decide on an option strategy and what you want to do. So let me see. Let's see.
That's
another
a good point.
question.
Yeah, I agree.
Yeah.
Just a real quick point to that. I agree completely with what you said. And I think that if someone's looking for a reason to utilize or build that ratio into a trading strategy, my suggestion would be, if those ratios start to look strange to you, or like they look really high or really low or whatever, I would utilize that as a signal to go look more deeply at what's going on, right? Do a little bit more digging into why that might be priced the way that it's priced. Because just like you said, the market may be forecasting something that's happening or potentially happening in the future, and you need to have your eye on what's going on that horizon, because that may be a large part of why the options are priced the way that they are.
Exactly. I couldn't say it any better. That's awesome. So somebody was asking also, how do I find the implied volatility? How do I determine whether it's underpriced or overpriced? So, once again, there's many different things that you can analyze. I know on our website, we have a whole suite of tools that are free to investors. So if you go to our website, we have a free 1-year historical and implied volatility chart. But many brokers nowadays offer very robust and granular tools that allows you to look at short-term charts, longer dated charts, IV percentile, IV rank, things like that. So there's all these different metrics But ideally, you really want to determine, you could simply look at an IV chart, and implied volatility chart, say, over, maybe a 2-year period. 2-year period, I felt like when I was trading personally, I like 2-year charts. I mean, I looked at all kinds of different charts, but I like 2-year charts because it gives you, 8 sets of earnings. It gives you, political news that happens within that time period, possibly election news. There's all kinds of things that happen in a 2-year period, and it kind of gives you a good idea. But how about yourself? I mean, when you were trading, what were you using to analyze high and low implied volatility? Probably a lot of the same tools, right?
Yeah. A very similar kind of suite of tools there. I didn't usually go 2 years out. That was a little bit farther in duration than I liked to keep my my examination of how vols were moving relative to the actual underlyings. What I used to do is have a constant rolling 10-day, 20-day, 50-day, and 100-day ratio of what implied options prices were relative to those n number of days. So I would have like the 10-day implied vol over the 10-day delivered or historical vol. And I would always look at that as one potential way to, that's your short-term metric. And then you have a 50-day, which includes like a month and a half worth of data. That's a 50-day implied vol over a 50-day historical vol. And so it would give you kind of the way I kind of think about that is it really just helps you to build a picture of what the market looks like right now relative to what it used to look like, 20 days ago. It gives you a very brief history in a few really distilled down metrics that are a lot of information, right? Goes into like building those metrics. But once you are able to look at those metrics and look at them in a distilled way, you can build a pretty quick picture of what's going on based on 4 numbers, right? And that's a really helpful tool, especially if you're trying to ascertain what's happening in front of you in an exceptionally volatile situation where you have to make quick decisions.
No, I think that's great. Yeah, and once again, there's no real right or wrong way to do this. There's all kinds of different ways to analyze implied volatility. And once again, I would check with your broker, because many brokers these days do offer very robust analytical tools that allow you to, determine whether, the current level of implied volatility is either inexpensive or expensive. And then once you know that, once you're armed with that information, now you can determine what's the best strategy, whether you're bullish, bearish, or neutral based on your forecast. So anyway, that's a lot of great information. I know we're right at our hour, a little over, so I'm going to sign off. But just let everyone know that if there were any questions that we didn't answer for you, all your questions do get answered. Somebody on our team will reach out to you tomorrow to answer your questions. But Matt, I'm going to hand it back to you to finish it up. And thanks again for the presentation.
Absolutely. Yeah, Ken, I appreciate you coming on and doing some of the Q&A with me. One thing that I really want to make sure that people understand is optionseducation.org is available on demand and free of charge all the time. And there is an incredible amount of options information there. And again, that email that that Ken mentioned is options@theocc.com. Make sure you send us emails and really lean on us to give you a leveraged kind of idea of how your options knowledge might be able to be broadened in order to make some better decisions. So lean on us at optionseducation.org. And hopefully we'll see you next week for a real deep dive into Skew on the 18th at the same time, 3:30 p.m. Central Time. Thanks a lot for tuning in today, and have a great day.